Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You are listening to Money on Tap. My name's Seth Cressman, and I'm here with
Ben Brayshaw. How you doing, Seth?
Doing well. You could reach us at 855-226-8551 or info@yourmoneyontap.com. And this week, we're going to have a conversation with you about a solution if we do get into a bear market. We're going to talk about bull market, bear market, and we've talked last week about this bubble. What is a bubble and possibility of something like that popping, things going sideways or down. Really, sideways wouldn't be so bad, but down is what people want to try to protect against in that bear market, which is inevitable and part of everybody's journey through investing. But how can we help you?
That's a great question, Seth.
Well, it is the question. I mean, that's what we're here for. We're planners and partners at Brayshaw Financial Group. So as financial planners, we have these conversations and we prepare for these periods where the market is not doing what we would like it to do. We'd love to be able to just say, you know what, the market's going to go up, 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 all the time up. But that's just not the way it works. And you can do some things that are different than, just sitting there and writing it out. Or you can sit there and you can write it out. But in a plan, something that should be approached from that perspective is, what do you do when the market doesn't go up, 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 up? So we've gone through this last year. 2020 was interesting. We've had one of the longest bull markets that we've ever been able to record. It's certainly one of the longest ones that I've ever lived through. And maybe that's a different experience for you.
Well, seeing that you're only 10 years old, Seth, it's not a lot.
But we also went through a bear market this last year. And maybe you don't even realize that. I mean, as you were just doing whatever you were doing, trying to get a mask on your face and your kids and, figure out, are you going to have a soccer game this week or not? Well, a lot of things changed in the market, and we went through a bear market this last year. And so there was some things that happened with that, or traditionally do happen with a bear market in some ways that you can maybe be investing differently. We're going to talk about what do people with wealth do when they get into a bear market. And we're going to talk about, what's possibly different about a bear market cycle today or in our present tense than the past. So with that, I promised we're going to have some fun. We got a loaded show, and you are listening to Money on Tap, and it's time for Money in the News.
Well, Seth, first up here in the Money in the News, we've got Google and Facebook trouble down under will spread. Sorry, I read that wrong. This is a nice Wall Street Journal article, which we go to regularly, written by Jackie Wong. It's interesting what's going on here, but the Australian Parliament is now dealing with they're calling it a negotiation. I like that scenario that they put under the fact that they're proposing a law here, but it's a negotiation. That basically, with these algorithm changes that are going on in the world around news, that they have to disclose what they're doing to allow certain things to pop to the top versus others, and the changes they're making in this. This is like the crux of we have a lot of debate in the U.S. about what news and what's relevant and stuff that gets pushed aside and doesn't rise to the top versus other things that do it. I mean, this is I'm actually really proud of Australia actually implementing some, something going on here to control the news output so that all of a sudden somebody who's in superpower says, you know what, we're just going to turn this item off, and we're going to turn this one on, or shut this media outlet off, or shut this one on, turn this one on. I mean, those are big deals right now.
Yeah, Facebook and Google are top of the list for pretty much any platform out there that is pushing news or something in front of you. And that algorithm piece is something that, they hold pretty closely to. They're not usually telling everybody out there how this is going to work. So the Australian Parliament would like them to be very upfront with this and also start paying for news. So if you have a news link out there and you're a news, you create content, then basically Google and Facebook or whoever it is would have to start paying for that content. I don't feel bad about that at all. I think if you are a content creator, then you should be able to understand how things are being put at the top, and if they're using your content to be at one of those locations to attract more business, which is what they're about, is trying to create more clicks and funnel more feeds, then why shouldn't you receive some of what it is? I mean, my gosh, look at the market cap on these companies is astronomical. How much money that they're making and funneling through. So there you go. Maybe this is something that starts in Australia and winds up on our shores here soon.
Yeah, I think there's a lot to be learned from this, and I think there's. I don't care what side of the aisle you sit on. I mean, there's obviously tech control here that is extremely dangerous, and we have a tentative scenario here, and it's going to drive a lot of pieces because, we have. I mean, you got this organization banning, this company. You got. Now you got people that are, boycotting that company, and it's just, there's a lot of wind around all of this stuff and the control, and people are afraid. That's all this means. They're afraid of the big tech world because we are constantly becoming more and more dependent on it. And this is rightly so, right? I mean, it doesn't matter what side of the aisle you sit on. If information you're trying to get is not available or it's being shut off or shut down, I mean, that's a big problem. I mean, that is the problem with monopolies. I mean, that's why we have laws against it. Next up, Seth, we have another Wall Street Journal article. We actually have 3 today, folks. But, these are the headlines. I love going through these different things because some of them are pretty funny. When you think about the sarcastic world we live in, just naturally exists. But this one is Texas livestock industry reels from storm and outages. Okay. And this is by Jacob Bungie.
It's news and it is money. And we don't think of a lot of the time what could be happening right now in this livestock industry when you have a huge storm move through the U.S. I see the pictures of family that live in Texas and they're playing in the snow with their children. And this industry sees power outages and livestock and feeding, what do they call them? Feedlots that they cannot process. They can't get them pushed through to, the process of I don't even want to get into the details because that's, well, anyways, so you've got a bunch of cattle out there that they're having to euthanize out of kindness to them because they're just sitting there not being fed or not being able to get processed.
Yeah. I mean, they've got orange groves freezing. They've got pipes. People are out of power. What's interesting, Seth, about this winter storm that comes through Texas, which, by the way, okay, I love, okay, I'm going to go to the end of the article because the article's quote is, the quote unquote, the leading energy state has no power. Mr. Miller said, that's crazy. I mean, you think about Texas, you think about oil. And what's really gone on is that Texas has done a huge job of solar panels, wind energy, and so forth. And the solar panels are covered in a foot of snow. The wind farms are frozen and are not operating. And the only thing they have to use is fossil fuels. But because they have limited the fossil fuels, they are rotating various sectors. They're turning power on and off. They're turning power on and off for different areas so people can have heat and so forth for periods of time to try to keep people rotating heat. But then they've had so many problems that even the time periods in which they said they would be turning it back on haven't been able to actually happen. Now, if anything, the irony of green energy, it's kind of like, it's kind of like I think when Al Gore was supposed to go to D.C. and speak on, global warming in April or something like that, or March or something, and there was like a couple of inches of snow, which was like a total randomness, and then they changed it to climate change, right? So, I mean, no matter what the scenario is, it just seems like God might have just a little bit of humor going on here. And knowing all the green energy push that we have, I mean, I was looking at a picture the other day of a fossil fuel helicopter spraying fossil fuels on the wind farm to get it going again. Like, I was kind of thinking to myself, boy, I don't think we're ever going to be energy independent. That was kind of the irony that drives. Now, maybe this all gets resolved and we learn from this, hopefully, in various scenarios. But if I did learn anything, I think going completely fossil fuel zero is not possible. What if we have chaos in our skies and, we have massive amounts of, let's say you have an eruption from a volcano and it's got ash up in the skies. Does a solar panel still work? Because that ash doesn't clear out of the skies for a long period of time. Do they work at 50% or 20% efficiency? I mean, I have no idea, but the world has all sorts of things that create problems that can then, if we're depending on one thing or another. Now, I'm all for clean energy. Don't hear me wrong here. I'm all for it. I just think that we need to be careful that we don't create ourselves so clean energy that we're without power and dying, or our military can't operate their vehicles, or any of those things. For the same reason I felt like we needed to be energy independent from the Middle East when that happened, right? I was all for that. I'm for energy independence across the board. We can't be dependent on any one thing.
Yeah, we get to have some perspective, don't we? There's always seems like there's going to be like a turn the corner and we're going to have something that we're going to have to look at and face and say, well, we didn't plan for that. How could we have seen that coming?
No, exactly.
So, hey, again, that was Wall Street Journal. We're going to flip over to another article in the Wall Street Journal by Alexander Osipovich, which is a more industry related, which has to do with online trading. Now, there's an online trading platform that's going to be released, I think, in March, that will let investors bet on yes or no questions. And I think it's interesting that they put it in terms of betting. And for instance, how could this work? This could be if it had existed last year, you could have asked users whether a COVID-19 vaccine would be approved by the end of 2020 and bet on that, which seems absolutely incredible to me that they're looking to be able to do that with an online, like on an online trade.
Well, I mean, it's really just a gambling site, right? I mean,
yeah.
I mean, it's not like when you start adding stuff like that beyond buying stocks. I mean, and I would actually define anything as gambling that doesn't have a real expectation of a long-term investment, like a legitimate investment in an organization.
Right. Yeah. So it is more of a bet, right? Because you're not holding on to something for a long term. You're not able to kind of, ride it up or down like if you had a stock or an ETF or something like that. You're holding on to that. This is just a one and done, which really seems a lot more like betting. The people that have developed this is interesting here. They're 24 years old. Both are 24 years old. MIT grads, and kind of have some places where that I'm familiar with. Is Bridgewater and Associates is one of them. And but what's more interesting, I guess, is that the name of the platform is Kalshi, which is derived from an Arabic word for everything, which refers to really the breadth of topics that it's going to be able to question and potentially cover. So what would not be available for you to place a bet on here? And you wouldn't be able to bet on elections, for one. Okay. You wouldn't be able to bet on things like, let's say, war. Those are just, there's definitely things that they are not going to include here for the opportunity to do that. But the idea of having a kind of an all-inclusive betting site, or I mean, they will be regulated as well, so they will have to fall in line with whatever the regulators tell them they can and cannot do, or how they can or cannot do it. But it's a very interesting concept.
Seth, I would liken this to, like, someone would say to me, like, if I went to a boxing match and I placed a bet, that's gambling, right? I would say that would be the case, but does that mean you can't invest in I mean, you could literally be a sponsor for a boxer, right? You could buy into the company, the organization of that boxer. You could be an owner of the boxer from that standpoint. Like, that's an investment because you believe in the long-term outcome of success. And I'm just using this. I mean, we don't own anything in boxing or, but my whole point is, but if you go to the match and you've got no stake in it and you place a wager, that's gambling. And I think people do that with stocks all the time. They're not interested in owning the company or owning the software or owning the rights to something or collecting revenue from yield. I mean, but if you say, you know what, here's a stock I think I'm going to make a quick buck on, that's gambling in the stock market, right? And I think, because some people, I mean, and I'm sure there's people that have listened to this say, hey, am I gambling? Because maybe that's not something I want to really be doing. And so that's where investing is. I'm actually excited about our show coming up because we're going to talk about bear markets and how to invest and look at bear markets and those pieces. So, this is one of those things. I do think that this is an interesting company. I think KKR is somebody we're very familiar with. I mean, they bought out a lot of different companies and financial firms. These are some smart people in their business and their investment. You could have an investment in a gambling company. I mean, or you have an investment in a trading company. I'm not sure how this pans out just yet, but it's still going to potentially be an IPO that comes out. I don't know. I don't know anything about it. They're just starting the company itself. Buyer beware, hardcore. It's kind of sad. You can't gamble on whether or not we're going to go to war at China. I don't know. It sounds like a good bet to me.
Folks, you're listening to Money on Tap. You could reach us at 855-226-8551 or info@yourmoneyontap.com and connect with Ben or myself. We're going to have some fun here in a minute because we're going to talk about bear markets. How do you invest in a bear market? We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well coming up here in the new year. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, we're going to talk about one of the least fun things, depending on where you're at as far as your take on it. It can be terrifying in terms of your investing and your ability to retire, which is what most people are trying to do with their investments, right? So we're talking about a bear market. To get us started, why don't we just go ahead and say what it is? Okay, so basically a bear market is a 20% drop in the market. Who defines this? A bear market is signified by a 20% or more drop in stock prices. And usually there's a period of time that has stayed below 20%. In the very recent history, we just went through a bear market, and so many people don't even realize that we went through a bear market this last year because it was so fast. And it was over in a month, 2 months, where traditionally when bear markets have happened, which would be 2007, 8, 9, there was several years that the market pulled back and stayed there before it kind of climbed its way through into the next bull market where it's going up. Okay. So it's in terms of how long or how much it's regular. It's about 20% is what the measurement is there. And it's traditionally been, a few years that it's taken, but today we are in a different place. We're going to talk about that. We're going to talk about traditional ways that you would want to invest in a bear market to try to offset some of those losses or take an opportunity to find some value in some places and spaces in the market that would allow you to what would we call it, a hedge, as far as hedging your money and putting it into a different place that would perform or outperform what the rest of the market is doing.
Seth, I think what's really interesting about this whole bear market conversation that everyone is kind of having, and it's not because we see it as an inevitable fact tomorrow. I think we see the writing on the wall in some areas, some sectors. We're seeing growth. We talked about this, last week about, the Russell and, semiconductor space. We've had astronomical gains. Some of them justified, though, right? I mean, we've gone to almost a completely technological work from home world. What would we expect other than that, right? I mean, that is the expectation that we're going to see those growths in those areas. And then the Russell 2000 and being, looking at small cap and so forth. Well, I would expect that too in the technology world, because that's where a lot of these technologies are coming out, the innovation technologies and the security technologies. These are things that there's a new demand. There's a new demand at a volume that is unprecedented in those sectors. I also think that you have to look at what's oversold too, right? A lot of people got out of the energy sector because they owned a lot of the energy sector and sold out and went to technology. The question is are people coming back? Where's money flowing? And I think that's where, when we come into that first point, that sector analysis is absolutely crucial, right? I mean, the number one issue is what sectors are you investing in? Not just what stocks. What sectors are you looking at? And how does that play into your overall goals or your overall expectations or your overall thoughts on what the market's going to do?
So there's some popular strategies to pay attention to. And one of the no-brainers here is what a lot of people rely on, which is selling. If I own something and it starts to go down, and if I can sell it today and put it into cash, and then just wait for it to come back, or look for another opportunity, that's selling out, or we call it going to cash. Or some people like to flight to safety would be another one of those terms, where people go into the bonds or the bond market as an attempt to still have something that they're holding on to, giving them a return, but it's not Apple, which is now down 50% from where it was yesterday or last month. And that is one of those things where when we take a look back through the history of bear markets, it is not uncommon to see the market pull back or go to lose 50% of what it was last year, or wherever the high was. And so, that makes sense, going to cash, right? I'd rather hold cash. We'll come back and we'll play another day, so to speak. Another technique is really going into defensive strategy. And there are companies that have traditionally been these types of companies that you would want to own through pullbacks. And some of those might be food, alcohol and tobacco has been a very popular place for people to put their money, but also, the staples like toiletries and paper products. And, these are places, and it makes sense when you think about it. Like, well, people are going to buy toothpaste. People are going to, buy toilet paper, or these types of things. So why would I go and try to hold on to something like that is what people are going to want and like, and their balance sheet is going to survive very well, no matter what, instead of these other growth companies or the technology sector or something like that. And that's kind of what Ben was really just talking about.
Yeah, I mean, I think one of the things that people need to look at when they look at their sector, Seth, is and we do this. I mean, I look at my spreadsheets constantly, and I'm looking at 50-day and 200-day moving averages. I'm seeing trends. I'm looking at that, and there's a lot of there's the investor who's long-term. This company's going to be huge one day. I don't ever want to look at it. I'm buying the stock. Sayonara. Don't call me when you're having a bad month, bad quarter, bad year. I'm in. There's that investor, right? And then there's people who are investing to maximize gain and flow. But when you look at these 50 and 200-day moving averages, you're looking at the last 200 days that stock. You're looking at every day's close for 200 days, and you're looking at that line graph. And is it tilting north, going up, or is it starting to tilt south? Are you moving below that average? That is an indicator, and you have to understand that everyone out there who's an actual trader, money manager, are watching these trends because people trade on trends. They're following a trend. If the trend's up for a week, they follow it for two. I mean, and I'm making that up. I mean, but there is a variable trading strategy out there that you can almost pigeon anyone into. But they're all watching technical analysis. They're looking at those charts. That technical analysis are charts and data and hardcore information that people are trying to evaluate. Does this make sense for the future? You might be the average investor who's riding this wave since March 23rd. I can't tell you how many people are saying, you wouldn't believe how much money I made in the stock market in the last year or the last 11 months. Like everyone thinks they can trade stocks. I have a 17-year-old son who's learning this, and he's making money in the stock market, and he's like, yeah, I have friends that think they're Warren Buffett. It's a real issue because when the market's good, it's easy, or it appears easy, because all of the work is when the market goes down. And I think that's the hard part that people don't understand, and they don't know when it happens or how to do it or how to prep for it. Like, I look at various recessionary stocks, Seth, and, I was doing research on articles, and one of the, one had like 10 assets, and and we'll get into some of these things, but one of them listed Kellogg as an investment. Now, I'm not recommending Kellogg. I'm not saying you should go buy Kellogg, but it was in the article. But I'm looking at Kellogg right now, and I'm just on Yahoo Finance, and I'm looking at the 5-year chart, and I'm looking at, wow, it's really down. I mean, it's not as down as it was back in 19, but it's down, and it's down over the 1 year too, comparatively. But it's not as low as it was on March 23rd, right? So I'm looking at all these moving pieces, and it's ironic that Kellogg was listed here, and I was kind of looking at Kellogg as an interesting indicator myself, because I'm like that, like McDonald's, like Walmart. You start talking about these companies, and we all say, yeah, Walmart is a real indicator. That's a safety stock. That's what people go to when they think the market's going to. But are those the only stocks? I think you made a great point in our pre-conversation about this thing, Seth, about other stocks that have now changed as safety stocks.
Yeah, who would have thought that when the market pulled back like it did in February and March, that technology was going to be the flight to safety? I mean, people came to and started buying technology like they never had before. Zoom is one of those stocks that people just bought, and it went through the roof. But it was a make sense scenario why they would want to own that during a pandemic, because everybody was now not flying, right? People were like, get out of those airline stocks, get out of the cruise lines. We're going to get to work. And how are we going to get to work? We're going to get to work because of technology. We're going to get groceries because of technology. There's been a lot of changes. Honestly, we couldn't have told you that was what was going to happen, or that was what was coming down the road. It was just incredible to witness what we've witnessed. But traditionally, there's sectors that we start to pay attention to. And that's one of the ways that people can invest, or traditionally have invested. and knowing which sectors are going to, and technology was one of those sectors that people invested in, but traditionally is a growth sector and one that you would want to avoid and get out of as quickly as possible. The places where people would traditionally go would be, healthcare stocks. Okay, because no matter how bad the economy is doing, guess what? People still need to get to the hospital and get looked after, unless it's a pandemic and then everybody gets all their surgeries canceled and all of.
I know. I was thinking about that.
No more plastic surgery for you. But all those elective surgeries were just put on the sideline, and everybody went over to this. It's just been a bizarre year. But we're going to talk about the possibility of something pulling back here, right, in the very near future, which we're not trying to predict again. We're just having some fun talking about this. Precious metals, gold, silver, platinum. Those have been traditional places where people have gone during a period of recession, and that's gold and gold futures could be I shouldn't say that, but gold has been a place where people have traditionally gone. If you've looked in the past and looked at the charts, when does gold do really well as a commodity? It does really well when the market has a pullback, because that's one of those places that's considered a flight to safety. Now, does it mean that it has to do well? No, it doesn't. It's just one of those things.
Seth, you make some really strong points on the pullback piece on that, especially with the precious metals. I think healthcare and precious metals are probably two of the most boring investment spaces that you can do, but they are great indicators. They're wonderful indicators. And I like precious metals. I really do. And if I look at the last, 12 months, I'm just looking at like the gold ETF and we're down, sizably down. We're probably down 10+% from that high. And, I look at the, that's year to date, actually, I should say, but over the last year, we're barely up. And so there's some pieces here that we need to kind of evaluate. And I'm not talking about like, hey, you should go invest in gold and buy that. We're not saying any of those things today. What I'm saying is, if you're not using indicators to evaluate your positioning in the market, you're going to get caught off guard. You're going to get burned. You're going to be the person who hears about it last. Okay. Now, you're never going to make the right call. Okay. You're going to sell and you're going to watch the market go up and you're going to be like, why didn't I stay in longer? And you know what? You're human. You're just like me. I say the same thing. I'm sitting on this side of the table. And if you don't understand that we're fallible, that's an issue. Okay. We are fallible. But I also look at the technical indicators, and I own a stock and I had made a good amount of money on it. Now, I personally owned it, and I showed my son how I was like, man, I never thought this stock was going to do this, and I just sold my principal out of it. The stock continues to rise and rise and rise, and I'm like, holy smokes. He was laughing about it. He's like, I can't believe it. Now, forget that stuff. You don't ever invest in anything that's doing that with your core money. But we were laughing about it. I was laughing with another broker friend of mine. But I told him, I said, now I'm playing with the bank's money. You have kind of a random win, pull your capital out. Let the bank's money, let the stock market's money run for you if that's the case, and then you know everything's gravy. But then what do you do with that money? How do you invest that? Take that back to a core position. Look at things and see, at that point in time when you take that capital out, the story is really this. What is the market doing? What's the healthcare sector doing? What's the precious metals sector doing? Is it pulling back? Because if it's pulling back, that means people are getting out of those precious metals to get into other investments, right? Precious metals become attractive when everyone gets afraid. You want to own everything when no one's afraid in the precious metal space, right? You want to own the healthcare sector when it's down, not when it's up. You don't want to be following the reverse trend. You don't want to be buying things when they're high and selling them when they're low and saying, oh, I should have been in precious metals now because now the technology sector's crashed. No, you should have been in precious. That means you have to be willing to take profits. Never lose sleep because you took profits. Never lose sleep because you made money on something and you didn't make the top. When you make your dollars and you're happy, you move. You should have an idea, and we have said this over and over and over again. You should have an idea of what you expect out of that stock before you hit the buy. Because at that point, you're an investor. When you don't know what you expect out of that stock, and I mean relatively, then you're not an investor, you're a gambler. And those are the pieces that catch people off guard, because if you don't have an expectation of what you want out of it, you're stuck in that stock independently and you have no idea when to exit correctly. Know what you want, know how you're going to get it, and then know how you're going to reallocate. Those are the pieces of a successful trader inside a bear market that's coming like a lightning bolt, in my opinion, over the next 6 months or so. At some point, we're going to get hit.
Folks, you are listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about how to invest or be an investor or remain invested, whichever your strategy is, during a bear market when it's going down. What happens? How do you do what you need to do to protect yourself or to be successful as an investor during this time? So it's not this time, right? We're not there. But Ben, you just said maybe in the next 6 months or so. I was like, wow, you stepped out. You really stepped out there and called it. We'll see, right? Because we're going to be here in 6 months and we're going to be talking about something like this. But anyways, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We've been talking a lot about, bear market. What is a bear market? How to be thinking about your investments in a bear market and understand how not every bear market is the same. But as an investor, traditionally, there's places where you could go to kind of hedge yourself and still be invested. And if you're looking for and trying to create income for yourself in retirement, these are critical components for you to understand. But we're going to talk more about that. Actually, we're gonna try to land this ship with how to be successful and how to hedge yourself and still be okay through retirement, because that's most of the time what we're talking about here. So in terms of where to invest, okay, traditionally those have been places that, utilities has been one of those sectors. And we've talked a lot about sectors. And why would a utility stock do well? Because you're got to keep the lights on, right? So you're going to be paying those bills. And they also traditionally and most of the time have a dividend. And so why would that be important? Ben, what's a dividend and why is that important for somebody that's retired?
Well, dividend is that's the income yield that's coming off of a stock. And, a lot of people are looking for yield in retirement. We talked about baby boomers. We talked about, the movement and flight to safety, not because people are concerned. And we're talking about, hey, listen, recession, these are concerns. These are issues. We see something potentially gearing up. I don't know that we have a recessionary event coming for sure. I mean, it was kind of interesting when we ended at that. I really do see a pullback coming. A recession is that 20% hit. Do I see 20% for sure? No, I don't see that, Seth. Do I see a 10, 15% pullback at some point, a sharp kind of experience? I can totally see that. And I think it's going to be very sector-based, which is interesting. And I think there's going to be a flight to safety, and I think all those things are going to happen. And how much we get going on that, really depends on what, how the dominoes really fall on this thing, right? But when you're talking about the dividend and yield, these are a lot of flight to safeties for a number of reasons. But when we talk about baby boomers and we talk about, 35, 40 million people being retired right now, and then we got another like 85, 80 million more to retire on top of that over the next 20 years, finding equity stocks specifically that have high yield has been a high demand. We've seen that trend on a number of charts. MFS has a chart sheet that says over the last 20 years, you can average over 7% on large cap value stocks. I mean, that's 7.07. It's right on their numbers. And, anyone who's interested in looking at that chart, I'm happy to share that with you. Give us a call, email us, info@yourmoneyontap.com, send you the sheet. What's interesting is you'll see a constant rise over the last 15 years or so of demand in those value those value large cap stocks because they have an indication of big boy kind of safer than the small cap world, though they can be just as volatile and risky as any other stock out there, but they have yield. And when we talk about blue chips and big stocks and big boys and all that stuff, we're talking about like the Exxons, the Chevrons, the AbbVie. We're talking about big companies, like Dow kind of like components for the most part. And, but we're seeing that interest because a lot of the bond yields are so low. Like, I mean, I just read an article that junk bonds were starting below 4% for the first time in like history. It was crazy. A junk bond paying 4%. I'm like, I don't want to own a junk bond. That's not in my story. So, but that's a crazy scenario because interest rates have dropped so much. But that tells me that's why there's a large flock to high yield equities, because you can own a company who maybe doesn't even sell junk bonds, who might pay a better dividend because you're looking for income in retirement. As we kind of deal with all these sectors, ones that are oversold, some that are maybe overbought, and trying to evaluate that space, it's very, very complicated. I mean, this is not, we're going out of an easy trading environment and we're entering a more difficult one. I mean, stocks that I could say, hey, listen, I could buy. I was literally talking to a client the other day. He's like, man, 3 months, 4 months, 5 months ago, you had 30 stocks you liked. Today you got 10. I go, it's getting tighter. It's getting tighter. It's getting more complicated. Those are real conversations that exist inside this world because that's the new truth. That's the new reality we're dealing with. I'm not looking at, energy stocks that are, trading at, 20% of their value a year ago. I'm not looking at financials that are, I love JP Morgan under 100. Well, it's way over 100 now, so is it time to get out? I don't know. That's your decision. These are the pieces that we have, and we have to figure out when we start going from having value in a stock that can produce value for you long term, whether it has a value intrinsically with a dividend or it has value because it's going to grow. These are all things we have to understand. And then on top of it, Seth, you bring that core conversation in of like, where is the market going? Because we have so many people who are retiring that's changing the dynamic of how they invest every day. Every day. You bring in utilities. I mean, a real core conversation. I mean, I've seen utilities pull back, go back up. I've seen gold pull back, go back up, pull back. I mean, people are nervous. I can feel the nervousness, right? And the question is who's pulling out and when? We talked a little bit about last week, people are taking some profits, and just saying, hey, I'm out of here, but then you have other people who are hanging on and trying to figure this whole thing out and trying to, you just don't really know. And I tell people, if you're invested, stay in for the long term. That's really, you have to be an investor in solid companies.
We're going to take a quick break. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. Hey folks, Seth Cressman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
Now back to Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are going to be wrapping up this show here that has been all about the investing that you might want to consider or should be thinking about. How do you stay invested, or how do you go through a bear market? We've seen a lot of bull market in the recent 10 years, like since basically 2009. We just went on one of the longest bull markets where the market continued to rise and rise and rise and rise and rise until this last year, where we pulled back 33%, somewhere along there.
Yeah.
And we went into a bear market, but it was so fast in comparison to the other bear markets that we've experienced that people have like completely forgotten. Like, oh my gosh, we went through a bear market this last year, folks. And still, most people in their investments, if they just stayed invested and say, whatever index fund they were at, they've pulled through and they're doing okay. And I think that was one of the things that I wanted to talk about, Ben, is in a plan. If you are right now looking to retire in, say, the next 10 years or 20 years, or if you're 5 years away from your retirement, how do you stay invested? Because we hear time and time and time again that people that stay invested pull through and they do okay, where statistically investors in the market have done somewhere around 2 to 4%, depends on who you're getting your research from. But does that sound at all like what the market has given? Or like you were talking about the like a large cap value sector of stock investing would be somewhere close to 7%?
Well,
what do you do to get that?
That's just the average. I mean, that's just what it's done over the 20 years. I mean, there's been some really bad years inside of that. And, if you're not a long-term holder, you're going to get burned in that concept too, because that gets oversold and then people sell out of that. And, it's like, it's just.
Can I pause? I just want to stop you there for 1 second, Ben. And I appreciate what it is that you're saying, because I think that's part of the conversation that people need to understand. Is these flight to safety areas, which we've talked about precious metals, we've talked about utilities. We didn't really talk about bonds. And that being one of those places where people traditionally go as a flight to safety. Does that necessarily mean that it's going to continue to rise and do well over time? Well, not a whole lot of people know that we've basically experienced around a 30-year bull market in the bond market, of all places. But it is a sector and it is an investment that will have volatility. It will go up and it will go down. That was what I got to say. Thanks.
No, that's right on. And, even with the bond market being kind of oversold, the interest rates being low, I mean, that's still a flight to safety in a recessionary environment. Someone will take any percent. I mean, how many people have money sitting in the bank? I mean, I think if we took a raise of hands of our listeners, it'd be an enormous number of people have some money sitting in the bank and they're not making any money on it. So a bond paying anything is going to be better than the bank potentially in a recessionary environment. So people are going to leave stocks and go to bonds. And those are all kind of those pieces that exist. Talking about bonds and talking about safety and talking about all those pieces, it leads me to another conversation that I instantly want to talk about, because I remember pre-2008, before the crash, 07, 06, 05, I remember talking to people about, hey, listen, we had the crash and, the dot-com crash, and then, 8 and 9 was the financial crash. So in between those things, people had recovered from 9/11 and all of those things had happened. I did a lot of business during those mid to later 2000 years, 06, 07, where people laughed me out of the room, literally laughed me out of the room about buying an annuity to hedge a portion of their investment. Literally told me, yeah. And I would be like, we had the dot-com crash. I mean, just just create a foundational element. We've talked about building a house on this show a zillion times and having foundations. And I was talking to somebody who was in our office the other day, and I was telling them, I said, listen, you're all in the stock market. Everything. Even your bonds. I mean, bonds go under too. I mean, have something in a foundational investment. Foundational investments are cash. Foundational investments are CDs. Foundational investments can be different types of annuities. But, you can have different types of foundations with annuities too. You could have pension income-like annuities, or you could have just, some sort of fixed rate of return annuity that might be a little bit better than a CD. In this day and age, that actually is the case. And, so those are things that, you need some foundational elements. And I would say as the market rises, adding to your foundation is important. What I find, though, is when I speak that language to a lot of people, Seth, I mean, how many times do we, I'm going to go buy more bonds. Well, that's more foundational-like, but there's still some major component issues that are company intrinsic that can still affect some of those bonds. I mean, where are the Enron bonds?
Bonds can go down in having this illusion that somehow a bond is not going to have a factor of volatility, or that it can go down, is very much like the precious metals or utilities. These are places where traditionally people have gone for safety, but we've seen time and time again, especially in the more recent market cycles that we've gone through, is that these will go up and they will go down. So how do you? I mean, the CD is a guarantee. That, like you said, that can be a hedge. Some annuities they can have some guarantees, but those foundational elements need to be able to get you through the market cycles, the up and down of the market cycles, and somehow create or continue to provide an income for you.
Yeah, Seth, you're right on there, and I think in some annuities, depending on what you're looking at, I mean, you could be buying equity-based annuities too, variable annuities as they're called. There's all sorts of risks to all these things, but you can buy pure fixed annuities that can give you the ability to have a CD-like return. Depending on the asset, could be tax deferred even. There's different things you can do as the market rises. I always tell people the same capacity to shed stocks as you make money. Take some of your principal off.
Taking that profit, yeah.
Yeah, don't be afraid to take profit. Profit's good. And I think, honestly, as I was talking about last week, people are going to be taking profits just to cycle through the tax returns that are the taxes that are going to change for us. I mean, people are going to say, hey, you know what? As soon as April, May, June hit, I'm going to take some profits and cycle my stock. I think we're going to have various stock cycling and if you don't understand this, give us a call, but they're going to cycle their stocks, their non-qualified assets, their taxable assets, so they can pay the taxes today under today's tax code and then move forward with new tax codes as they're happening under the new administration. So this is a problem for our stock market, knowing that capital gains taxes are going to be affected. It's going to force people to think, should I sell?
Are you setting us up for next week's show? Because that's what I feel like. We're going to have to come into next week and explain what it is that we're talking about. Cycling, for like selling your non-qualified assets and cycling, because we're in a tax code that's preferable compared to what we might be looking at in this near future. I think we need to go ahead and call it a show. And thank you for being with us here at Money on Tap. Now, you can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also join us next week. And I think we're going to be talking a little bit more about, some taxes and how things could possibly look in the future with the new administration, because that sounds like fun, right? Because that's what we told you we're going to have some fun here today. Hopefully it's been hopefully you've had a great time with us here. We enjoy and we appreciate you being here with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. There's the podcast, Money on Tap. We've got a whole vault of over 160 shows that you can listen to there to try to find what's important for you and how to be successful in retirement. That's a goal that we have here for you at Money on Tap and Brayshaw Financial Group.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.